One of the other important points as we come to the end of this module that we need to talk about is the quality of the financial statements. There's typically called 3 levels of quality of financials, but that's leaving out those that are prepared by an organization itself. If our organization is small enough, we're not listed, maybe we have very few shareholders or investors, we might be creating, in our accounting department, our own financial statements. Those are called internally or self-prepared. And if that's what we do, and that's acceptable to all the parties, that's fine. We don't try to judge those from an external standpoint. The 3 levels of quality that we want to be aware of in looking at financial statements are compilations, reviews, and audits. So let's take these in order. The simplest of these 3 is a compilation. A compilation means that we have gone to a certified or chartered accountant, given them our information. They make sure that the information is compiled, is put into our financial report, consistent with the accounting rules, whether using GAAP, which is generally accepted accounting principles, or international IFRS, International Financial Reporting Standards, or a local accounting standard. What are the rules? Does the financial statement follow the rules? That's all a compilation does. There's usually no footnotes. There's usually no explanations. It is very basic. It is certainly a step beyond internally prepared, but it has no independent verification of anything. So if we're looking to secure some investor money, probably a compilation is not going to satisfy their needs or regulators. If we're going to go to a lender and try to secure a loan, in most cases, they're not going to be satisfied with a compilation. But absence the need to secure any financing, a compilation might be satisfactory. The good news is it's the least expensive of the 3 forms for obvious reasons. It has the least amount of work. If we want to step above a compilation and move up significantly in the quality of the financial reporting, then we'll have a review. A review is a financial statement created by our external accountants. It will follow the rules. They will go through some very basic steps to assure, not ensure, to assure that we are following the accounting rules. They're not going to do any audit or any testing of our policies and procedures, but it is significantly stronger in what the external accountant does than a compilation. For many organizations, a review is good enough to secure the lender money they want. Again, it's significantly more in a review than a compilation as far as input from the accountants to make sure that we're following the accounting rules. So compilation is the most basic. Review is a significant step up in quality. And then we get to audits. Audits are the strongest of the 3 levels of quality. Now, I want to be very clear. An audit is not a guarantee that the financial statements are 100% accurate and complete. That's not their intention. It would be impossible in most organizations to verify 100% of the transactions. There's just too many of them. Every listed or public company is required to have audited financial statements. Many non-listed companies, if they are large enough with external investors and lenders, choose to have an audit. An audit is much more comprehensive than is a review. In an audit, the external accountants will come in and do what they call representative testing of not only transactions, but our systems, how we report our transactions internally. They will give an audit report that says a couple of things. It's usually 3 paragraphs on a single page. Does the financial statement fairly represent, accurately represent the financial position of the organization? Are they following the accounting guidelines? And will it be an ongoing entity with no exceptions to the rules? It's a significant step up in quality from a review. And it costs anywhere from 2 to 5 times as much. But it gives external investors, suppliers, customers, lenders much more confidence in the numbers. It makes the financial statements much more transparent, and in most countries, it meets the requirement of the government. The last area we will cover in this particular module is the 2 most common forms of accounting rules we have. There's GAAP, which is generally accepted accounting principles, and IFRS, International Financial Reporting Standards. There is constant debate and argument as to which one is more accurate, which one is more conservative. I will tell you from experience with a lot of companies, organizations in different countries using one versus the other, they're different. GAAP is perceived to be, shall we say, more liberal than IFRS, but there are plenty of examples where that could be questioned. GAAP, which is frequently referred to as US GAAP, is the form of accounting that has been around for a very long period of time. It is what's called rule-based. We have these rules that tell you what you can and cannot do in accounting. Currently, there's over 12,000 pages of rules, and they do update the rules on a regular basis. It's based on the US standard. It really focuses more on product organizations or manufacturing organizations than service organizations, because the original principles are more than 100 years old. Basic idea is we're going to give you the rules, and if we don't say you can't do it, maybe it's okay. Compare that to IFRS. Now, International Financial Reporting Standards started in London about 40 years ago when a group of international accounting societies got together and said, it's too difficult to try to create financial statements for our individual organizations when every country has its own accounting rules. We must come up with some global standard. From that period of time, gradually more and more countries are adopting IFRS. Number one, it's principle-based. Number two, there are a lot fewer standards or requirements than under GAAP. The whole approach is different. Under GAAP, if the accounting rules don't say you can't do it, it might be okay. Under IFRS, unless the standard says you can do it, the assumption is that you cannot. So on the surface, IFRS is more conservative than GAAP. But if we were to dive deeper into the individual standards for IFRS, we would find that some of them, and we will be addressing a few of those later in subsequent modules, seem to be much more aggressive than the GAAP standards. So it's just 2 different standards. The gradual trend around the world, to include in the US, is to migrate every country's accounting rules to just one global standard, the International Financial Reporting Standards. And eventually, everyone will be adopting these standards. So what you can see from what we have covered here, and a lot in our time together, is accounting has a lot of very interesting elements. There's a lot of individual pieces of accounting that might seem on their own to not have significant value or to not be clear. But as we move from this into the subsequent modules, you will begin to see how each of the pieces of the puzzle fit together, how each of these small elements begin to come together to show us what really is important in our organizations. We'll be able to see some of the very interesting transactions. We'll be able to understand much more about what's going on in the organization. So until next time, this is Daniel Feynman. This is the end of Module 1 in accounting.
Outstanding. Thank you so much, Daniel. And if you are taking notes, it's time to apply some of those things that you've been learning today. Look forward to being with you again in the second module, which has more interesting stuff that you can apply into your business. Thanks again.